Hi guys, so welcome to lecturer in Within Show. Very much excited for having you. Today we are looking at financial management, and we are looking at one key topic in financial management, and that is going to be sources of finance and cost of capital. Sources of finance and cost of capital. Whether you like it or not, there is a question in the exam hall waiting for you on the sources of finance and cost of capital. So we're going to go through the concept of the sources of finance and then how we can also calculate the cost of capital. If you remember when we started this live sessions about 4 weeks ago, I gave you the overview of the syllabus and about financial management. I mentioned that these are key areas that we need to understand. Key areas that we need to understand. So if you have any questions about financial management, or you have any question about whatever it is that you are looking at, you comment below with any questions that you have, and I'll be answering all of your questions for you. So we are looking at business finance. And business finance is divided into two: sources of finance and then cost of capital. Okay, sources of finance and cost of capital. So if you're just joining the broadcast and you have any questions about financial management or whatever it is, put it in the comments box or in the chat box, and I'm going to be answering all of that for you. Yesterday I shared some key nuggets on what you must do before you register for the examination, and in case you missed yesterday's live broadcast, make sure after watching this lesson you go and watch that as well. I shared 5 strategies or techniques or factors that you must take into consideration before you write you register for the exams. Now, business finance is critical for those of us writing financial management, ACCA, ICAG. It's very critical for us there in relation to what we must understand. And like I always, like you know already, when it comes to the financial manager, there are 4 key roles that the CFO plays in the organization, and these 4 key roles are what is breaking down into the various topics that we have in management accounting. And one of those 4 key roles that the CFO helps the organization to make is the issue in relation to financing decisions. So with financing decisions, we are asking ourselves 2 questions. That is, where do we get the money from, and what is the cost of that money? Where do we get the money from, and what is the cost of that money? So for instance, where do we get the money from is the sources of finance, all right? And then what is the cost of the money is the cost of capital. Because as a business, if we want to expand, if we want to grow, we want to finance investments, we want to acquire another business, we want to buy an asset, we want to undertake corporate restructuring and corporate corporate reorganization, it has to be financed. The question we ask ourselves is, where do we get the money from, and what is the cost of that money? Because no money is free. If the shareholders are bringing in the money, there is a cost of that money. The returns that we need to give to them is the cost of the capital. If we go to the bank to go and borrow the money, the returns that we must pay, the interest expense that we must pay becomes what? The cost of the capital. And like I mentioned, this is a fundamental area in financial management, and whether you like it or not, there is a question in the exam hall waiting for you on business finance, theoretically sources of finance, and with calculation, the cost of capital. So let's get into it, and then let's see how it goes. If you have any questions what to do, put it in the comment box or in the chat box if you are live, and then I'm going to be answering all of that for you in relation to that. My audio real quick. Good. Good. So we're back. So sources of finance and cost of capital. Like I mentioned, there are two questions that we need to ask ourselves. Where do we get the money from, and what is the cost of the money? Now, when we are asking the question about where do we get the money from, we must first ask ourselves, what type of money are we looking for? Because there are, when it comes to financing decision, there are short-term financing decision and then the long-term financing decision. So in the short term, for working capital management and to be able to assist the company in making various decisions, we have short-term sources of finance, and then to be able to undertake long-term investment decisions, we also have the long-term sources of finance. It is very important for you to understand that an entity cannot use short-term sources of finance to finance long-term investments, or use long-term sources of finance to finance short-term changes in working capital. So this topic is closely related to the issue about working capital, which is also one of the fundamental topics in financial management, all right? And we'll be going into all of those things as we continue in our discussion. So, where do we get the money from? In the short term, what are the sources of finance to an organization? What do we have? Number one, we can go for bank overdraft, certainly. Alright? So in the short term, the organization can go for bank overdraft. Now, what is bank overdraft? The bank overdraft is where an entity is allowed to withdraw an amount more than what is available in what? Its account. So that at the end of the day, the extra amount overdrawn, interest is paid on that, and immediately money is brought into the account or a deposit is made in the account, that amount is deducted by the financial institution. The reason why I'm mentioning this is because there's a difference between bank overdraft and short-term bank loans. Bank overdraft and short-term bank loan. So in the short term, the company can go for bank overdraft. So for instance, our money is $20,000 in the account. So that is how much money we have in our account. So if we want to undertake, or we need to pay our creditors, or we need to buy some inventories, then what do? And we need more than $20,000. We go to the bank, and the bank may allow us to withdraw $30,000. So that extra $10,000 becomes what? A bank overdraft facility. So that is the first thing you must understand. In the short term, the company can raise money from bank overdraft. Then we come to the second aspect. Another thing about short-term finance is short-term bank loans. Short-term bank loan. Now, there is a difference between the bank overdraft and the short-term bank loan. With a short-term bank loan, this is where instead of us saying that, okay, bank, allow us to withdraw 30,000 even though we have 20,000 in our account, we will tell the bank that, listen, borrow or lend to us the $10,000 for 3 months or maybe 6 months. And that is going to be what? The short-term bank loans. So the difference between the bank overdraft and short-term bank loans is this. One, with the short-term loan, there is a definite time for what? Repayment. So it's in 3 months' time, it's in 6 months' time. That is when we are going to be paying it. But with the bank overdraft, there is no definite time. Immediately money hits our account, the bank is going to be what? Deducting it. That's one aspect about that in relation to that. Then with a short-term bank loan, it also allows the entity to plan well, so that you know that you've borrowed the money for 6 months. So if you have borrowed the money for 6 months, it allows you time so that when money comes into your account, the bank doesn't deduct it like they would have done in the bank overdraft. So there are some cases, companies in looking for short-term finance may not prefer bank overdraft, but would rather go for what? A short-term bank loan, so that it will enable the company to plan within the short term and make various decisions about the organization. So in the short term, We need money to pay creditors. We need money to pay our employees. We need money to buy some inventories. We can go for a bank overdraft, or we can go for a short-term bank loan. Another short-term finance that you need to know about is trade payables. Trade payables. Now, trade payables is one of the sources of finance to an organization. How? Because the money that we would have given to the creditors as payment for the goods that we bought from them is going to be used for what? Another purpose in the organization. But you've got to be careful. Even though trade payables is a good source of finance to an organization, the longer it takes an entity to pay for its debt, its payables, the entity is going to be losing what? Goodwill. Okay? Because if you owe me and I gave you 1 month to pay, but you take 3 months to pay the money, next time you come, I will sell the goods to you on credit. So even though this is a good short-term source of finance, the entity must be careful not to overuse it and affect the goodwill of the organization and future losses of suppliers in relation to that. So trade payables, another short-term source of finance. So what are we saying here? In the short term, bank overdraft can be raised. In the short term, we can have the short-term bank loan from the bank. Then also we can have the issue in relation to trade payables. Then we come to the long-term bank loans. Remember, to be able to finance changes in working capital, entities will go for what? The short-term bank loans. But if the entity wants to do an expansion, undertake research and development, or launch a new product, or buy some equipment, or buy some assets, then we cannot use bank overdraft, then we cannot use a 6-month short-term loan, then we cannot use creditors' money to finance that. Rather, we need to go for a long-term bank loan. Now, if we are dealing with a long-term bank loan, one thing that you must understand is the pecking order theory. The pecking order theory simply states that when entities are looking for finance, they first go into their coffers and deal with retained earnings. From there, they look at debt finance before they will come to equity finance. So that is a pecking order theory. So if an entity wants to finance an operation, want to finance an undertaking, want to finance a work in the long term, they will ask themselves, how much money do we have? How much profit have we retained over the year? If that will not be enough, or they still don't want to use that, then before they go to the shareholders, they will go to the debt finance. But the question we ask ourselves is, why is debt prioritized over equity? Because debt is tax deductible. The cost of capital, that is the cost of debt, is tax deductible, but the cost of equity is not tax deductible. What does that mean? That is where there is a concept of OPM, other people's money. Because when you borrow the money, the interest that you are paying will be deducted for what? Tax purposes. Okay? Will be deducted for tax purposes. However, if you use shareholders' money, the dividend you pay to shareholders will not be deducted for tax purposes. I hope you are getting the concept. So that is what you need to understand in relation to why debt is prioritized over equity, that it is tax deductible. Only that, one thing you must understand in relation to interest expenses is that when you get to the highest level and you are doing tax, you will realize that the interest expenses allowable for tax purposes, we use the ratio 3:1. That is, the debt should be 3 times the equity of the company to be allowable for tax purposes. But that is not where we are thinking. All we are saying here is, in the preparation of our profit statement, interest on debt will be deductible for tax purposes in relation to that. So that is a pecking order theory. It then means that in the long term, there are various ways through which an entity can obtain finance. So the entity can use debt finance. The debt finance. Now, if an entity is using debt finance, what are some of the examples of debt finance? There are various types of debt stocks that you need to understand. We have the long-term bank loan. Okay? Long-term bank loan. This is where we are borrowing the money for 5 years, for 3 years, for 10 years. Long-term bank loan. Short-term bank loan is for short-term. Okay? Debt finance, we can get it from bank loan. The entity can also issue some debentures. Okay? It's also a debt finance. The entity can also give the issue in relation to loan notes, or if you want, bonds. All of these are some examples of debt finance that are used interchangeably in understanding how we will deal with the issue about debt finance. Then when it comes to debentures, we have the naked debentures, the cumulative debentures, and all of those breakdown of the various forms of debentures that we have. But that is the first aspect, debt finance. Then we come to the second leg, and that is equity finance. Now, when it comes to equity finance, there are a couple of things that we need to understand about equity finance. For instance, issue of new shares. If an entity wants to raise money from shareholders, from equity shares, then the entity may decide to what? Issue new shares. So for instance, if the company is quoted, then there are 4 things that the company can do. The company can undertake what is called public issue, and I'm going to be explaining this. The second one is public offer by tender. Offer for sale by tender. Third one is placing, and the fourth one is right issues. So a company that is already listed on the Ghana Stock Exchange market, or on the London Stock Exchange market, or on the New York Stock Exchange market will go for money on the stock exchange. Well, how will they go? The first one is they can do what? A public issue. So with a public issue, the company sells the shares directly to the public at a fixed what? Price. At a fixed price. So like MTN did, issue shares at 0.75 Ghana cedis per share, or 75 pesos per share. So it is called public issue. Only that in the case of MTN, they did not issue those shares because they wanted money. They issued the shares because it was part of the regulatory requirements for them getting access to the 4G acquisition or bundle from the government. So if they did that to satisfy legal regulatory requirements, and not necessarily for them to raise finance, because the money that was actually raised from the issue of shares was actually used to finance other things. So really, it wasn't because they needed money, it was just to satisfy the legal regulatory requirements. So the first way a quoted company can raise money from shareholders is the public issue. So with the public, like Tesla is doing now, as at the time that we are having this, Tesla is issuing, I think, some 2 billion stocks that the CEO, Elon Musk, is going to buy about $10 million of those stocks. I think so, $10 million of those stocks. So it is public what? Issue. So we want to raise money. What do? We go to the public and raise money. Then another option available to quoted companies is to do what is called the public offer for sale by tender. With this one, a sale directs to the general public. However, the price for the shares is not fixed, and the public are invited to bid for the shares. So with a public issue, the company determines the share price. It is $2 per share, and they sell it out. But with public offer for sale by tender, the entity is selling the shares, but there is no fixed price. Rather, the shareholders or the potential investors are going to bid, and definitely the shares will be issued to the highest bidder in relation to that. Okay, Evans, I see your question. I'll be answering that in a moment. Let me finish with this one. So public issue, what are we saying? The entity issue the shares at a fixed price. Public issue for sale by tender. The company issues the shares but at no fixed price. Rather, the buyers are required to make a bid, and then the shares will be issued to the highest bidder. Then we come to the third option available to the companies, and that is called placing. Now, with placing, a sponsor, usually a merchant bank, arrange for its clients to buy the shares. However, at least 25% of shares are made available to the general public. So with placing, the company issuing the shares doesn't really go out there saying that we are selling shares. What they do is that they arrange with a merchant bank, they arrange with a financial house, so that the financial house will sell the shares to its clients. However, anytime a company is undertaking a placing, at least 25% of the shares that they are trying to issue should be made available to the public. I hope you get a concept, to be made available to the public. And the last form available to the equity shareholders or source of raising finance from our equity shareholders is the issue in relation to rights issues. Now, you will realize that with the first three options, everything is in the public domain. But there are times when a company wants more money but doesn't want dilution in the ownership of the company. So if the company doesn't want dilution in the ownership of the company, then they will do what? Rights issues. Rights issues has to do with the issue of new shares to existing shareholders in proportion of their current ownership. The issue of new shares to existing shareholders in proportion to their current ownership, or in the proportion of their current ownership. So that is the right issue. So for instance, we give you one new share if you have 4. So 1 for 4 or 2 for 5. So we give you 2 new shares for 5 outstanding shares. So with right issues, the shares are issued primarily to the existing shareholders. What are we saying here? If we are going to go for a long-term source of finance and we don't want to use debt finance or loan stocks, we can decide to use equity finance. And if the company is quoted, the company is listed on the stock exchange, then there are 4 options available for it. It can do public issue, it can do public offer for sale by tender, it can undertake placing, or it can do make a right issue where the shares are issued to the shareholders or the current shareholders in their current ownership ratio. Okay, so this is the option available to listed or quoted companies. What if the company is not quoted? If the company is not quoted, there are 2 options available for it. If the company is not quoted, it can decide to become what? Quoted. It can decide to become listed on the stock exchange. So that when it becomes listed on the stock exchange, it will now have access to what? Each of those options. Or the second option is to remain unquoted. That is, the company can decide to remain unquoted. And in the case that the company decides to remain unquoted, it means that new shares can only be issued by way of right issue through private placing to the existing shareholders. So if you are a private company, you are not listed, it means you cannot do any public issue, you cannot do any public offer for sale, you can only undertake what? Placing in relation to that. However, it is also difficult for companies to be listed on the stock exchange. So there are various requirements that must be met before companies will become listed on the stock exchange. Some of the issues has to do with the size of the company. Some of the issues has to do with the management structure of the company. Some of the issues has to do with the how long the company has been in existence and the financial statements of the company. So there are various requirements that must be met before an entity can be listed on the stock exchange. So with equity finance, that is what we are saying. The entity that is quoted will be undertaking these 4 options, but an entity that is not listed, that is not quoted, has 2 options: to become listed and enjoy these, or to remain unlisted and raise new finance through private placing from the existing shareholders. So that is the second thing you must understand about long-term sources of finance. Remember, as we are dealing with all of these things, that is, where do we get the money from? The second aspect is, what is the cost of that money? What is the cost? So what is the cost of the capital? So if you are using debt finance, what is the cost of the debt? If you are using equity finance, what is the cost of the equity? That must be taken into consideration very well. So I see a question from Evans Nomashi. Let me answer that real quick. Then we can continue. So Evans, let me go to my slide. Right, Evans. Good evening, sir. What is the difference between bonus issues and scrip dividends? Bonus issue and scrip dividends. I'm actually coming to that thing in a moment, so you're going to be getting the concept there. Now, bonus issue and scrip dividend looks alike, but they are different. So let me explain them for you. Bonus issue is simply the issue of new shares to the shareholders using what? The reserves of the company. In other words, it is turning reserves into share capital. So for instance, the company has been in operation for a long period of time and has a lot of reserves. So if the entity wants to meet a set, like the way the banks did, many of the banks in Ghana here did bonus issue. Why? Because they were having a lot of reserves. And Bank of Ghana says meet minimum capital requirements. So what do? They converted the reserves into share capital. So when an entity converts its reserves into share capital, meaning shareholders are going to have more equity shares, but they did not pay anything for that. We are just turning reserves into share capital. In that case, that is referred to as a bonus issue. Note that technically that is not a source of finance because no money is coming to the business. Or we are getting it. No money is coming into the business. We are just turning reserves into share capital. So shareholders' shares are increasing, but they are not paying anything for it. Now, the idea with scrip dividend is simply offering shareholders new shares instead of cash dividend. So scrip dividend is offering shareholders new shares instead of dividend. So for instance, the company is required to pay dividend, or the company wants to pay dividend. So instead of the company paying the dividend, the company rather issues shares to the shareholders. When the company does that, then that is referred to as what? Strip dividend. So we strip them of their dividend, but we give them equity shares. But with bonus issue, they are not stripped of any dividend. We will still pay them their dividend, but we take the reserves, which has been over the years, and convert it into share capital. So these are the differences between the straight dividend and then the bonus issue. So Evans, that is the answer to your question. I believe it is clear. If it's not too clear, you can put it in the comment box and let me know what else you want me to look out for. If you are watching this and you have any questions, we are looking at business finance, and we started the journey about the fact that we are looking at the sources of finance, that is where the company gets the money from, and then the cost of capital, that is what is the cost of that money, and this is the required rate of return, how much return we must make in order to be able to pay back for the loan or the money that we have received. And we said when it comes to the sources of finance, two things: there are short-term sources of finance and then long-term sources of finance. And we said in the short term, an entity can raise finance from bank overdrafts, can raise finance from short-term bank loans, can raise finance of trade payables. And we've given the differences or the reasons why an entity may opt for a short-term bank loan instead of a bank overdraft. Then there is also the long-term sources of finance. In the long-term sources of finance, an entity may go for the pecking order theory, where we look at retained earnings, then we come to debt finance, then we come to equity finance. Then we said the reason why debt finance is prioritized over equity finance is because debt finance is tax deductible. Debt finance is tax deductible. Then we said with the debt finance, it can be a long-term bank loan, it can be debentures or issue of what? Loan notes and bonds. Then from there we came to the fact about equity finance. And we said with equity finance, at the end of the day, what is going to be happening is that it will be dependent whether the company is quoted or listed, or the company is unquoted or unlisted. So if the company is listed or quoted, then it can do a public issue, selling the shares at a fixed price, or public offer by tender, selling the shares with no fixed price, and the potential investors will bid, and the highest bidder will issue the shares to them, or placing, where we are arranging with the merchant bank or with the financing house, so they sell the shares to their clients. However, about 25% of the shares we are issuing and are placing must still be available to the general public. Then the last thing there is rights issues. And we said right issue is the issue of new shares to the existing shareholders in proportion of their current ownership. So everything here is going to bring dilution in the ownership of the company. Public issue, new investors will come in. Public offer for sale by tender, new investors will come in. Placing, new investors may come in. But with right issue, if we don't want to dilute the ownership of the company, we still want, what we can do is to issue shares to the existing shareholders in relation to that. Then I answered the question about for Evans, and that is the difference between strip dividend and then bonus issue. So we said strip dividend is offering shareholders new shares instead of cash dividend. Offering shareholders new shares instead of cash dividend. However, when it comes to the issue about bonus issue, it is turning or converting reserves into share capital for the organization. Note that technically these two things does not bring really money to an organization, because it is not something that will benefit the company in any way by bringing in any new form of cash. Then another concept, in addition to Evans's two concepts, that is the strip dividend and bonus issue, another concept you must understand is the issue about stock split. Stock split. Now with stock split, this is where the share price are split in what? Value. Stock split is also not a source of revenue to the government. For instance, if the share price of a company is $1, stock split simply means the company will say now one share is $0.5, or if you want 50 cents. In that case, it means that we are just increasing the number of the shares, but the value of the share actually remains the same. So if, for instance, the share price is $1 and I have 100,000 shares, it means my money is, my worth is what? 100,000 Ghana cedis. Remember, this 100,000 cedis is equal to 100,000 shares. Are you getting the concept? But if we do a stock split to say that now a share is going to be 0.5%, that means now my number of shares will increase to 200,000 shares for me to be able to still get my $100,000 share value. So these are the terminologies that we have to understand when we are dealing with equity finance. Very, very important. Then remember also that if the entity is unlisted, if the entity is unquoted, then the entity has two options. It can decide to become listed and do any of these, or remain unlisted, and in that case we use private placing to do an additional, or to obtain an additional share or capital from the existing owners. Another issue about the long-term finance is the issue about sale and leaseback. Sale and leaseback. This is also another source of finance to an organization in the long term. Now, like the name suggests, for those of you who did F7 financial reporting, that is ACCA F7 or ICAG financial reporting, or strategic business, you're going to be doing that. You must understand is the issue in relation to sale and leaseback and how it should be accounted for. So when it comes to sale and leaseback, how do we, or why is it a source of revenue to the government? This is how the sale and leaseback concept works. So for instance, an entity has an asset, okay? It could be a factory, it could be their head office, but they need money. So they will arrange with the financial house so that they will sell the building to that person, but they will agree that, hey, we still need the building for our office, so you will lease it back to us. Now, what does that mean? It means that under a sale and leaseback arrangement, the entity is able to get access to large sum of money at a go to use for planning, but now we'll be paying the rent on the annual basis. So let's say the fair value of the building is $10 million. So the company sells it and receives $10 million for its business. Then the company will lease it back by paying maybe a minimum lease payment every year by paying, let's say, $100,000 every year for the leases of the assets. So that is also one of the options available to companies if they want to raise finance. But sale and leaseback deals are structured in two ways. Sale and leaseback deals are structured in two ways. And in financial management at this level, we are not really going to be looking at how they are structured and their effect on the financial statement. All we have to note is we need to look out for about how much we are going to be raising from the facility. But if you are doing financial reporting, strategic business reporting, or corporate reporting, F7, financial reporting, ACCA or ICA, you'll be doing this under IFRS 16. Now, one of the things you must understand about this is that with a sale and leaseback, it's in two forms. It is either the company sells the asset and loses control of the asset, or it will be a financial arrangement. So if the performance obligation is completed, if we transfer ownership, risks and rewards in the asset fully to the lessor or to the buyer who becomes the lessor, then it is a sale. So we recognize the whole revenue. But if we didn't transfer all the risks and reward in the asset, then it is a financial arrangement. So sale and leaseback can be in twofold, but like I said, in financial management at this level, we're really not going to be looking at the technicalities of it like we'll be looking at in leases, in financial reporting, in corporate reporting, or in strategic business reporting. We are just going to be asking, okay, this is our building. We are selling it. How much can we sell it? $10 million. But please, lease it back to us. How much will you lease it back to us? $100,000 every year. That is another option available for a company. Then still with the issue about finance, in addition to looking at these traditional sources of finance, there is another source of finance that is referred to as Islamic finance. Okay? Islamic finance. So that is also there. Islamic finance. Islamic finance. Now, I may not talk about this really here, because here as a result of that, but I'll just give you some overview about all of the financial instruments under the Islamic finance. We will discuss it in much detail later on. Now, you will realize that in each of these sources of finance, there is a cost to the company. There is a required rate of return that we need to pay. I think I see a comment. Let me see who is commenting there, if there is a question there. Job Adaba, thank you, sir. Okay, Job, you are welcome. Thank you for watching. If there are any questions, you put it in the comment box or in the chat box. Be very much excited to answer you. Okay, so if you have any questions, put it in the chat box or in the comment box. I'll be very much excited to answer it for you. So each of these financial instruments you see here, there is a cost, there is an interest, there is a benefit, because with a bank overdraft, we need to pay interest to the bank. With a short-term loan, there is an interest to pay to the bank. Trade payable, it is free. There is no tangible payment that we will give to the supplier for using his money, but there is an intangible cost if we delay the payment, the loss of goodwill. Debt finance, we need to pay interest. Equity finance, we need to pay dividend. Sale and leaseback, depending on the arrangement, we will be incurring some financial cost. But the sweet spot is the use of Islamic finance. And this is well developing across the world, so much so that there are many institutions in Europe, educational institutions in Europe, that are offering degree and master's program purely in Islamic finance as an alternative financial instrument or arrangement that businesses can go for in relation to that. Now, the concept under Islamic finance is that under the principle of Islamic law, wealth must be generated from legitimate trade and asset-based investments. Listen to this carefully. So we're going to be dealing with some Islamic laws here with my Muslim friends. Love them so much. Under the principle of Islamic law, wealth must be generated from legitimate trade and asset-based investments. Also, investments must have a social and ethical benefit. Speculative investments are not allowed, and investment in such areas as alcohol and gambling are forbidden. What we are saying here is that in the Islamic law, you are not supposed to charge interest for giving somebody money. You are not supposed to benefit negatively from giving something to somebody. So under Islamic law, for instance, if you lend me money, the benefit you get shouldn't be interest. It is illegal to charge interest in the Islamic law. Rather, you could enter an arrangement with me, a partnership deal with me, where you would take a part of the cake. So under Islamic finance, there are a number of financial instruments that you have to understand. And for your information, the examiner can ask you for between 5 to 10 marks to talk about Islamic finance as a source of finance to the organization. So let's look at some of the financial instruments under Islamic finance. They have some interesting names there that you need to understand. Right. The first terminology about Islamic finance is riba, that is interest. So riba, that is interest, is forbidden under the Islamic law. I've already mentioned that. So let's look at some Islamic financial instruments. Islamic financial instruments. Like I said, you have to be aware of these Islamic financial instruments and also understand them so you can write them out. Because if the examiner asks you to, the examiner can state them and say explain, or the examiner can ask you to explain 2 or 3 of them, and it's a culture, you should be able to go through it. So we have what we call murabaha. So let me list them down, then we go through it. Ijara, mudaraba, musharaka. Today my Muslim friends are going to beat me for messing up with some of these things. Shakuk, the pronunciation for messing it up. So mudaraba is like credit sales. Okay? Ijara is like a lease. Okay? Mudaraba is like an equity finance. Musharaka is like a venture capital. And then Shakuk or Shukuk, it's S-U-K-U-K, is like debt finance, and that is Islamic bond. So these are the 5 that I'm going to be going through with you about Islamic financial instruments. Islamic financial instrument. So murabaha, like credits, trade credits. Ijara, like a lease. Mudaraba, like an equity finance. Musharaka, like a venture capital. Shakuk or sukuk. Shakuk or sukuk, depending on the school you attended and the teacher who taught you phonics and the environment you are coming from. Sukuk or shakuk, that is what? Debt finance. So let's look at them one after the other. What are they? So let's take their definition. Musharaka, like I said, is effectively like what? Credit sales. So this is where the customer receives the goods but pays for them later on a fixed date. Okay? The customer receives the goods but pays for them later on a fixed date. However, instead of charging interest, a fixed price is agreed before delivery, the markup effectively including the time value of money. So remember, riba, which is interest, is forbidden in the Islamic world. Riba, which is interest, is forbidden in the Islamic world. So if riba or interest is forbidden and I sell goods to you on credit, how can I benefit? They benefit by taking into consideration the time value of money. So you know that if I sell goods worth $100,000 to you and I ask you to pay in 2 months' time, you know $100,000 in 2 months' time will not have the same value like it has today. So we are going to arrange or fix the price in such a way that we will take into consideration what? Time value of money. So that you will be paying in 2 months' time, maybe around $102,000. $102,000. So that extra $2,000 is to take care of what? The time value of money. It is not interest. It is not interest. I know somebody will say, Nhyira, that's how I know it's indirectly an interest. Yes, you will call it an interest, but riba or musharaba, murabaha, murabaha, we will call it what? The time value of money. So it is like a credit sales, like payables. Okay? When you buy goods from somebody, does the person put interest? There are some suppliers that will tell you, if you are going to, there are some places if you are buying, if you pay now, the price is different. If you are going to pay in 2 months' time, the price is different. In that case, they are adding interest on it, not technically the time value of money. But here, we don't call it interest because riba is forbidden. We put in time value of money. So that is murabaha. Then we come to the second one called ijra or ijara. Ijra or ijara. So what is the concept about ijra or ijara? Remember, that is the same as what? A lease. It's the same as a lease. So this is effectively a lease where the lessee pays rent to the lessor to use the assets. The lessee pays a rent to the lessor to lease the assets. Depending on the agreement, at the end of the rental period, the lessor might take back the assets, effectively an operating lease, or might sell it to the lessee, which is effectively a finance lease. Whatever the agreement, the lessor remains the owner of the assets and responsible for maintenance, insurance, thus incurring the risks of ownership. So the second one is ijra, which is a lease. So with this one, I need an asset. I don't have money to buy the asset, but you have it. I can't also buy it from you. So what do? You lease it to me so that I pay you a rent for using the asset. That is called ijra. It's a way to finance what? An organization. It's a good deal. So that we don't go for money to buy the asset, we can still use an asset over a given period of time. Then we come to the third instrument, and that is muduraba. Muduraba. Muduraba is synonymous with what is called equity finance. Equity finance. Now, what do we mean by muduraba? This is similar to equity finance or a special kind of partnership. Here, the investor provides capital and the business partner runs the business. Profits are shared between both parties, but all losses are attributed to the investor, limited to the capital provided. I love this one. So this one is like a limited partnership. Okay, I have an idea, but I'm broke. I don't have the money. You have the money, so we will enter into what? Muduraba. So you run the business. If we are running the business, any profit that comes, we will share it together. But if there is any loss, you will bear the loss to the limit of your money that you have invested. Why? Because I don't have any money in it. So instantly there is a loss, you're going to be the one to pay for it, limited to your capital. I hope you are getting the concept. So that is the idea about muduraba. That is equity finance. It's a special partnership. I have the idea, I don't have the money. You have the money, you don't have an idea, you don't have time to run the business. Okay, so you bring your money, you finance the idea, I run the business, we share the profit. But most importantly, when there is a loss, you are the person to bear it because I don't have any money in the business. So that is a concept about what? Muduraba, equity finance. Then we come to the fourth one is musharaka. Musharaka. Musharaka is similar to what we call venture capital. Musharaka is similar to what is called venture capital. So this again is similar to a partnership. But here, both parties provide capital and expertise. So be careful here. This is the same as this, but this time around under musharaka, both parties provide the capital and what? Expertise. Profits are shared between the parties according to whatever ratio is agreed in the contract, but losses are shared in proportion to the capital contribution. Now, you know venture capital companies. If I have a company, I'm running my organization, and I want investors, and I invite a venture capital company, what do? I am already running the business, I have the expertise, I have the money in the business, but they will come with the money as well as a member from the venture capitalist on the board. So it means the two of us, we are bringing on expertise, we are bringing on money. For that reason, any profit will be shared among us in our capital, in our profit sharing ratio, and any loss will also be shared among us. Unlike muduraba, profit will be shared, but loss will be carried by the provider of the finance. In musharaka, profit and losses are shared between both parties. The providers, because both parties provide the finance as well as the expertise. So that is the idea about musharaka, the venture capital arrangement. Then the last one, shakuk or sukuk. Like I said, depending on the school you attended and the teacher who taught you phonics and where you are coming from. So this is like a debt finance, sakuk or shukuk. So let's see how that one is. This is equivalent of debt finance, that is Islamic bond. That is sukuk or shakuk. I prefer shakuk to sukuk. So shakuk must have an underlying tangible asset, and the holder of the shakuk certificate have ownership of a proportional share of the asset, sharing revenue from the asset, but also sharing the risk of ownership. An example may be where the financial institution purchases a property financed by a shakuk certificate and rents it out at a fixed rent. The certificate holder receives a share of the rent instead of interest and a share of the eventual sales proceeds. So that is the idea about shakuk. Now, Evans, I see your question. Let me finish with our brother Shakuk and then I'll answer your question for you. So with shakuk, it's a debt finance with an underlying asset. So this is the arrangement. I don't need the asset. What it can do is that what a financial, all right, and then they will sell you a bond that you go and buy, and that is a shakuk certificate. So you buy the bond, which means you have an ownership in that asset that I'm going to be leasing from the company. Now, any profit that is generated from that asset, you have a share in it because you are what? A bond holder or the shakuk certificate holder. So these are the 5 financial instruments available under Islamic finance. So what are we saying here? We are saying that where do we get the money from? Sources of finance. In F9, in financial management, whatever it is, one of the job of the CFO, that is the Chief Finance Officer, is to ask, where do we get the money from? And very, very soon across the world, Islamic finance will actually take everywhere because it's a very critical issue there. So, Murabaha, Ijara, Mudraba, Musharaka, and then Shakuk. These are the instruments for the financial available for Islamic finance. Okay, so Evans Nomashi, let me look at your question real quick. Please, what if the partner running the business is careless and takes decisions that result in the loss of the company? Will the capital provider still bear all the loss? Yes. So Evans, your question is about Muduraba. Yes, he will still bear the loss. He will still bear the loss because I am running the company. I don't have any money in the company. You provided the finance. So if there is any loss at the end of the day, you will be the one to incur the loss. So yes, certainly make reckless decision. But that is why in the contract there will be some conditions. There will be some landmarks that must be met. There will be some KPI, key performance indicators that the provider of finance will be using to monitor his investment. So that immediately we are seeing that I'm making decisions that are not meeting the KPIs, then he can make decisions as quick as possible to avoid the loss of his capital. So yes, the partner can make a decision and it can result into a loss. But once he is not contributing any money, he is not obliged to pay anything. However, if it is about musharaka, that one, you have the money, you have the expertise. I have my money, I have my expertise. So we are together in it. If it gets wrong, we all bear the risk. If it gets better, we all get the benefit in relation to that. So that is the idea about what you must understand about sources of finance. Any questions? Any questions about sources of finance? I'm going to be concluding here today, and God willing next week we will look at, did I say next week? It's like I'm in class, right? God willing, tomorrow, same time, make sure you join me. We will look at the calculation aspect. Everything we've done in this video today is to talk about the theories, the English. But remember, there is two questions we are asking. Where do we get the money from? Sources of finance, and then what is the cost of the money? Cost of capital. Cost of capital. And God willing, tomorrow we are going to go to the second part of this lecture and look at the cost of capital. So we will look at the cost of equity, we will look at the cost of debt, then we will look at the weighted average cost of capital. We will use the dividend valuation module. We will use the constant dividend, the constant growth in dividend. Then we will also use the capital asset pricing module. So tomorrow is going to be great. It's going to be a lot. I'm going to take this to another level and help you to understand what you are doing well. Remember, like I said, this is a done deal area. You see, one of the things I like about financial management is that, like, you know the topics that are coming down. You know the topics that are coming for real when it comes to financial management. You know that financial management, business finance will be there. You know that cost of capital will be there. You know that business valuation is going to be there. You know working capital is going to be there. So everything, you're going to have a question on it. So God willing, tomorrow, I'm going to be continuing with the second leg where we answer the question, what is the cost of capital? So Evans, you said something. Thank you, sir. All right, Evans, you're welcome. You are welcome. Just trying to type welcome. And I'm typing we, something like that. All right, so that is it about the discussion in relation to what we are doing today. I believe that you today in the discussion, and you're going to be arming yourself with it to be able to Job Adama, what time are you starting? So Friday. So since you have that topic, so even on the comment box in the live session that I will answer, you can prepare. Where I'm going to be financial, very about it. You will be able to provide you with this example. You are doing something, you'll be so that you can and financial management and cost of